Intuitive Machines grew revenue more than 4 times what it did a year ago and still missed the top-line estimate, and the earnings loss came in way worse than expected. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Intuitive Machines gets graded and traded. So, on the headline, revenue came in about 6.5% below what analysts expected. That's a miss on the top line, and for a small growth name like this one, missing on revenue always gets Wall Street's attention. And on the earnings side, the loss came in over 300% worse than analysts expected. EPS is what Wall Street grades a company on, and a miss this size on the bottom line is a real black eye no matter how the rest of the report looks. So, on the beat itself, this earns a D. A revenue miss combined with an EPS loss over 3 times worse than the estimate is a hard headline to defend, even when the underlying story is more nuanced than the surprise numbers suggest. And on consistency, this earns an F. When a company's track record of hitting the numbers keeps coming up short like this, Wall Street eventually stops giving them the benefit of the doubt on the guidance. Let's talk about the positives from the report. Revenue came in at $206 million, more than 4 times what they did in the same quarter last year. That's the kind of growth you almost never see from a public company, and it tells you the business is scaling into real demand, not just chasing one-off contracts. Here's the number I keep coming back to. Their backlog, which is basically the pile of signed contracts they haven't delivered on yet, hit a record $1.8 billion. That's up $1.5 billion from where they ended last year. Backlog matters because it gives you visibility into future revenue. So when it jumps like this, you can actually start modeling out multiple years instead of guessing quarter to quarter. They also closed 2 big deals that change what this company even is. They bought Goodwill, which is a ground station operator that lets them talk to satellites in space from anywhere on Earth, and they signed a contract worth over $600 million to build 3 commercial satellites. Together, those 2 deals turn this from a moon landing company into a full space infrastructure company. And this one is huge. The national security piece of the business went from 3% of revenue a year ago to 30% this quarter. That's driven by a July award for 18 spacecraft on the Golden Dome missile defense program. Getting picked for a Pentagon program of that scale is a stamp of approval that opens the door to a lot more defense contracts down the road. Management also stuck by their full-year forecast of $900 million to $1 billion in revenue, and they reiterated that they expect to be profitable on an adjusted earnings basis for the full year. Reiterating guidance after a monster quarter tells you they're confident the second half is going to keep converting. So on profitability, this earns a D. The gross revenue picture is impressive, but the actual profit line went the wrong direction this quarter, and that's what this grade is measuring. Now let's talk about the negatives from the report. The cash balance dropped $215 million in just 6 months, and they're now sitting at $367 million. They're spending that money on inventory, ground stations, and long lead materials for future lunar satellites, so it's investment spending, not waste. But at this burn rate, the clock is ticking on how long they can keep going before they need to raise more money. The operating loss got wider, going from $29 million a year ago to $47 million this quarter. The big driver was their general and administrative costs, which is the overhead of running the company. Those costs tripled year over year because of all the acquisitions and the ramp in headcount. Growing the top line is only half the battle. The market wants to see them show that at some point, growing sales actually turns into growing profits. The share count also jumped from 117 million shares to 162 million. That means every existing shareholder now owns a smaller slice of the company than they did a year ago. This is how growth companies fund themselves when they can't fund from profits, but it's still a real cost that shows up in the per-share numbers. the balance sheet is also getting more complicated fast. Goodwill, which is the premium they paid for the companies they bought over the actual value of the assets, jumped from $19 million to $379 million. That's a huge increase, and if any of those acquisitions don't perform the way they expected, they'd have to write that value down, which would show up as a big loss on a future earnings report. And here's the risk that doesn't get talked about enough. A huge chunk of this business depends on U.S. government contracts, NASA moon missions, Pentagon missile defense programs. The release itself flags government budget appropriations as a material risk. If Congress fights over the budget or funding gets delayed, this company feels it immediately. So on guidance, this earns a B+, reiterating a $900 million to $1 billion full-year revenue target and reaffirming the path to positive adjusted earnings after a strong first-half print is a real confidence signal. And on red flags, this earns a C-. The cash burn combined with heavy government customer exposure and rising goodwill on the balance sheet are exactly the things that would get flagged if this story hits any turbulence. Putting it all together, this is the quarter that changes what Intuitive Machines even is. Revenue grew more than 4 times, the backlog hit a record $1.8 billion, and they went from a moon landing story to a real space infrastructure company. But the cash burn and the widening operating loss are the price of admission, and the market has to decide if that trade-off is worth it. Overall, I'm giving this print a D+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. For me, selling a cash-secured put is a cleaner way in than buying shares outright, because this stock loves to jump on program headlines. I'd look at strikes about 15 to 20% below the post-print price on a 30 to 45 day expiration, so I have room if the cash burn story comes back into focus. I'm not chasing shares into post-earnings strength either. I'd let that first wave of volatility drain out before I put my money to work. So my play here is simple. Sell puts and skip chasing shares. For me, the floor strike sits about 20 to 25% below the post-print price, because that gives me cushion if cash burn speeds up or a marquee contract slips a quarter. My ceiling strike is closer to the money, and I'd only sell it if I'm genuinely happy to own the shares, given the $1.8 billion backlog and the reiterated EBITDA positive outlook. I like the 30 to 45 day window here, because it lets me capture that fat post-print premium without carrying single headline risk too long. That's why my floor lands about 25% below print. I'm holding my shares here, and I'd actually be looking to add if the stock sells off on cash burn optics rather than anything wrong with the backlog. The $1.5 billion backlog build in 6 months, the pivot to 30% national security revenue, and that reiterated $900 million to $1 billion full-year outlook really validate why I own it. The only reason I'd trim is if my position got too big, because cutting shares here undercuts the long-term upside this diversification is unlocking. So I'm holding and adding on weakness. If these were my covered calls, I'd roll them up and out rather than let my shares get called away cheaply, because the backlog momentum and the Golden Dome Award have really expanded the ceiling. If my existing calls are near the money and under pressure, I'd close them and rewrite further out of the money at 45 to 60 days out to keep more upside participation. I'm also not selling tight strikes into strength over the next few weeks, because that $1 billion revenue path and more contract announcements through the third quarter can really move this thing. My move here is roll up and out and protect the upside. For my leaps, the Golden Dome Award, the Goonhilly acquisition, and the 6th lunar lander contract all materially expand the 12 to 24 month thesis beyond what I was originally underwriting. I'm holding, and if Delta has run on me, I'd look at rolling strikes up and using the freed up capital to push duration further out. I'd extend into 2027 expirations to capture the recurring national security revenue ramp, because this quarter transformed the addressable market and my thesis is stronger, not weaker. So I'm holding my leaps and extending into 2027. If I were underwater here, this release actually validates my original thesis. 4 times year-over-year revenue growth, a $1.8 billion backlog, and a reiterated path to EBITDA positive for full year 2026. Rather than just buying more shares, I'd average down through cash secured puts about 15 to 20% below the current price, because that's the disciplined way to lower my cost basis. I'm not in cut loss mode here at all, but the cash burn does make me want to keep my position size reasonable rather than going all in. So I'm adding through puts and sizing carefully. Bottom line, this print earns a D+ from me. The backlog and diversification story genuinely upgrades the thesis, but the headline miss and the cash burn keep this in the willing to own it with respect category, rather than a slam dunk. Thanks for watching, and I'll see you on the next one.